of the year. Before the Christmas and New Year's holidays comes the performance reviews. Beyond discussing their accomplishments for the past year and goals for the next, many employees will be entering those meetings looking for year-end bonuses and raises or promotions for 2026. New research suggests they could come away disappointed unless they're in a hot profession or industry. Following years of growth, bonuses have been shrinking in size and frequency since 2021. Low hiring, firing, and quitting have led employees to, quote, hug their jobs, allowing employers to retain talent without large bonuses. A new study by ADP, the private payroll software company, analyzed payroll data from 12 million workers at employers with 50 or more people, showing a decline in bonus recipients. In December of 2024, fewer than 40% of employees received a bonus, down from 44% in 2021. Bonuses, typically concentrated among senior and high-earning employees, are common in contract-driven industries like construction and manufacturing. Last year, the median bonus fell 4% in December of 2024. Overall, employers are scaling back towards pre-pandemic levels, says Jeff Nizaz, Senior Principal Data Scientist at ADP. Most employers are projecting they'll keep 2026 salary increases flat, according to the latest survey by New York-based consultancy Mercer. On average, employers are planning to hold merit increases to an average of 3.2% and total increases to 3.5%, equal to 2025 increases. Jack Jones, a principal compensation and rewards consultant at Mercer, says that a combination of caution over the economy and a cooling labor market is prompting employers to keep salary growth in check. When the total number of unemployed is greater than the job openings, companies don't have to compete as much on salaries to attract or retain the best talent. Mercer's survey also shows employers planning fewer promotions for 2026. On average, they only expect to promote 9% of their workers, down from 10% who won promotions in 2025. But there are some industries where salaries are likely to rise more, either because of high profits or because of all the billions being invested in them even if they're not yet profitable. The first industry is artificial intelligence. Whether it's the technology companies building large language models or the startups building artificial intelligence applications, investors are forecast to pour $1.5 trillion into AI worldwide in 2025, according to Gartner. With the money flowing, companies are willing to spend on salaries for the right talent. Artificial intelligence engineers now earn a median of $184,000 according to PayScale. This past year, the fastest growing median wages were for development operations and senior network engineers, which have grown 12% and 10% respectively to $131,000 each, PayScale reports. PayScale Chief Compensation Strategist Ruth Thomas points out, however, that these wage increases are significantly lower than last year's fastest growers, which were in the 30% range. Notably, growing AI energy demand is boosting the market for nuclear engineers. Demand is up 108% from last year, with a median salary of $128,000 according to PayScale. If these higher base salaries weren't enough to entice workers, there are the bonuses, which account for 6.8% of gross pay in the information sector according to ADP. That's almost double the 3.5% of gross pay standard for all US workers. Again, medians and averages don't tell the whole story, like the extraordinary spending by companies like Meta for the very top echelon of AI talent. Behind higher base salaries, bonuses in the information sector average 6.8% of gross pay, nearly double the 3.5 US average according to ADP. This doesn't account for extreme outliers like the extraordinary spending by companies like Meta for top-tier AI talent. Driven by the so-called Magnificent Seven tech stocks, strong public market growth is projected to boost salaries for bankers and financial services providers by 3.7% next year, Mercer reports. As this industry relies heavily on bonuses, with 5% of total compensation compared to the 3.5% for average workers, this additional pay is also expected to rise significantly. Bonuses for traders, merger advisors, and wealth managers could rise significantly, up to 25% for traders per Johnson Associates. However, Johnson Associates also forecast a 10 to 20% sector-wide headcount reduction in the next 3 to 5 years, partially due to AI.